Hello traders, in this video we will learn about options selling. If you have not watched about options buying, through the link in the description you can watch it. Now let us go into the features of options selling. First and foremost is, in options selling you should have a minimum capital of around 1.5 lakh rupees for one lot. So that's why it involves unlimited risk. The unlimited risk here means we have entered into the trade with a large capital as your margin, so the loss can be maximum is undefined. The loss is undefined. But you can ask why? Then why? For the limited reward you have to give a large amount of margin. Instead you can go and sell. You can go and buy options. But the probability of winning will be very high in this option selling. This is very important. Out of 10 trades, the percentage of winning probability will be very high, around 50, 60 to 70% if you trade with a proper risk management. These are the very important features. And what are the advantages in option selling? The main advantages of option selling are, the value of option strike will become zero if it expires out of the money. So the option sellers first sell options, which means they will collect the premium from the buyers, and the premium will become zero if the option strike expires out of the money. So expires out of the money, it will become zero means even it will have a value of time decay. I will explain it in through Opstra. It will give high profits in a range bound market. I will explain it in through Opstra Define Edge. Here I have chosen Nifty options. I have chosen 20 October as an expiry, and the market, the spot was around 17,000. See here, 17,000 is the spot. So what is out of the money for call options? These are all out of the monies. So I am choosing 17,500. I'm telling market will not go above 17,500. So I'm going and selecting the 17,500 strike and selling it for 31 rupees. 17,500 call options, and I'm selling, not buying, for 31 rupees. See here, this is the payoff chart that you get. Selling one lot, 17,500, 31 rupees. You see the probability of profit is 85%. The market is around 17,000. Even if it goes up, you will be in a profit. Green table, green box, it's showing 1,565 rupees. The 1,565 is the premium that you sold, 31.3 rupees into 50. 1,565 rupees. You will collect this from the option buyer. Someone would have bought 17,500 call option, predicting that the market will go up by paying 31 rupees. That 31 rupees you are collected. So the break even point is, though you have chosen 17,500 as the price, but the break even is 17,531 because the premium will get added. So the probability is 84%, which means even if the market goes down, you will get profit. If the market goes up, you will get profit. Even if the market is in a range bound, you will get profit. I will show you it here. See, this is the point, 17,500 that you chose. Market is here. Case 1, market comes and it stayed here. You will get full profit. In case 2, the market goes down, you will get full profit. In case 3, even if the market is range bound, you will get full profit unless the market have not go above 17,500. This is the greatest advantage in options selling. But if the market moves violently upwards, on the loss side, your loss is undefined. See here, maximum loss. But the margin you required to initiate this trade is around 81,000 rupees. So roughly around 1 lakh rupees to execute this trade. That's why the retailers people will not sell options. So but the people who are having a large amount of capital will sell options by collecting the premiums from the retailers. So you can understand why more than 90% of the traders fail, because they buy options. This is the payoff chart. Similarly, in case of put options, you have to go out of the money put options. That is, see, 16,500 I choose, 44 rupees, 16,500 put option. I sell it for 44 rupees. See the payoff chart. If the market goes up, you will get profits. It is opposite. This is options selling. When to sell options? This is very important. During stable market conditions, since you will get the benefit of time decay, when the market is very stable, the premium will reduce its value as the time passes. That's one greatest advantage. So you can sell options when market conditions is very stable, non-volatile conditions. So how to identify the non-volatile market condition? You can identify it when India VIX is below 18 or 16. The market tend to get in a stable mode. Always choose out of the money strike price if you sell options, because out of the money options strike price will become zero if it expires out of the money. About options buying versus options selling, I will come out with the next video. Thank you.